Welcome, everyone, to WLTH Capital Management's Financial Markets Insight webinar. My name is Remington Borg. I'm the Portfolio Administrator here at WLTH, and I will be your host for today's session. If you have any questions that may come up during or after the presentation, please feel free to drop them in the chat, and I'll make sure that they get addressed. We're glad you're here today, and we think that you'll find today's discussion to be valuable as we unpack what's happening in financial markets and what it means for long-term investors. Joining us today are two members of the WLTH team. Rex Weeks, our Chief Investment Officer, will start us off. Rex holds a CFA designation and brings deep experience in both portfolio management and investment strategy. Rex leads the way on how we build and manage our clients' portfolios. We will also be joined by Sean Kennefic-Rogers, our founder and CEO. Sean also holds a CFA designation and brings over 20 years of experience in the financial services industry, guiding clients through a wide range of market environments, helping them navigate both challenges and opportunities with a disciplined research approach. Today's presentation will cover economic data, geopolitics and inflation, artificial intelligence, the markets, and finally, portfolio implications. Our goal today is to provide clarity in an uncertain market environment and demonstrate the thoughtful, disciplined approach that drives everything we do at WLTH. With that, please help me in welcoming Rex.
Thanks, Remy. Appreciate it. Thank you, everyone, for taking time out of your busy day. I know everyone's kind of get back in the swing of things after summer's settled down, unfortunately. Fortunately for us in Arizona, looks like it's going to start cooling down, so we're looking forward to that over here. Of course, like always, did want to jump in. Again, like always, we have a lot to go over, a lot to get you guys informed on. So to start, we're going to do a brief overview of economic data from the second quarter of 2026. A lot of movement in all of these areas. So starting off, rates, the 2-year is at 4.25%. That's up 45 basis points from the end of last quarter, and the 10-year is at 4.67, up 35 basis points from last quarter. We'll dig into that more in a little bit. All of these we'll dig into, just a brief overview. ISM surveys, so all three readings for manufacturing and services were above that 50 level. Anything under it's usually a contraction. The market is in a contraction, but all three were healthy for the months of the second quarter. Labor, so there's 111,000 average monthly payrolls added in Q2. That was an increase from the quarter one average of 68,000. And then the unemployment reading came in at 4.2%. That's 1/10 of a point lower than the previous month's reading. And then for growth, real GDP growth in the second quarter was 1.5%. And then the Q3 estimate, very, very early, but it's estimated at 5.8% for the third quarter of 2026. So diving into that real GDP number that I just mentioned, 1.5%, we saw a rebound in consumption. We talked a lot about how important the consumer is to the American economy, being a services economy. 1.5%, however, is a little low from what we'd like to see, below the 2.1 that we saw in Q1 and below the long-term rate of about 2.2%. Business fixed investment was strong despite an increase in interest rates. This, of course, was led by tech and infrastructure spend from AI. The strongest growth was in non-residential fixed investment, growing at 8.4% quarter over quarter. This is usually attributed to data centers, but was much broader this quarter. We saw capital spending by businesses, excluding AI-related spending, which had decelerated since 2023, actually rebound this quarter. So we're seeing a little bit more broadening out in that spend category. And then trade and inventories continue to create quarterly volatility, but they're not really signaling any underlying strength and weaknesses. That net export number was a big detractor, but again, we're importing a lot of these expensive parts for AI build out, whether it's data centers or chips. So that part was a large detractor from growth in the second quarter. With that, if we kind of strip down real GDP and look at something called real final sales to private domestic purchasers, so this strips out net exports, inventories, and government spending. This number grew at a healthy 3.9% rate in Q2, well above the 2.5 average that we've seen since the end of COVID. Basically, this number demonstrates that the core areas of GDP grew at an elevated rate in Q2, especially when we look at Q4 last year and even the first quarter of this year. So although the 1.5 number isn't where we'd quite like to see it, when we strip out those volatile aspects and look at the core growth that's driving what's happening in the United States, we see a pretty healthy number. So consumer sentiment. So consumer confidence improved from recent lows, but as you can see, it remains below long-term averages. People tend to be more optimistic about personal finances than the broader economy, so that could be part of the reason that this reading is where it's at. There are also two caveats that we kind of discussed when looking at this chart. Political uncertainty often influences sentiment more than actual spending behavior. That kind of makes sense. Like we said, we just looked at consumption rebounded, but this measure is still, I'd say in the dumps when looking at the overall chart. So a lot of political uncertainty right now, especially with midterms coming up, could be leading to this reading. And then historically, sentiment is not always a reliable predictor of market returns. As you can see, a lot of these low points have pretty big plus numbers next to them, which are attributed to the rebounds that happened from those lows. So again, in summary, confidence matters, but actual spending is often a better indicator. And then just another piece of labor market data that we kind of caught our eye this quarter, the personal savings rate. So looking at history of personal savings rate over time, which is just how much after-tax income is not consumed, this fell to 2.7% in June, the lowest reading since COVID in 2022. And before that, the great financial crisis in 2008. So obviously when we speak of those dates, those obviously weren't markets that were favorable, especially to equities. This number basically just means there's more spending today, but it can't keep up for forever. You can't, when savings at zero, people are out of money. We're not saying that that's going to happen, but when you stretch savings, obviously that helps consumption in the short term, but you can't continue spending forever. Looking at this and thinking about what's happening, you may blame the Iran war and the inflation spike, but you can see that this rate was also low in the first quarter before the conflict started, and low especially compared to the 6.9% average between 2018 and 2019, just before COVID. So the decrease is actually coming from a downtrend in wage growth that we've seen since the end of 2024. Consumers are spending more, but the rate at which wages grow has not kept pace with that spending, especially after you include or factor in inflation. So this might just be a byproduct of the low hire, low fire environment that we've talked about the last couple of quarters. But if something breaks and people need money, with the amount of money people have currently tied up in the stock market, if something breaks, the cushion for absorbing it, which is how much savings you have, is thinner than any point since 2007. So it's just, again, not something that's flashing red, but something that we want to keep an eye on. And then the two main charts we look at or talk about when we think about labor market, the total non-farm payrolls, and then the unemployment rate and jobless claims. So average growth in payrolls, like I mentioned in the second quarter, was 111,000, moderated from strong levels in the previous two readings to 57,000 in June, but again, remaining slightly healthy, especially when last time we met, we talked about how we really don't need any job growth right now with the environment that we're currently in to keep going as an economy. So unemployment is at 4.2% and has remained steady, and initial jobless claims moved down to their lowest level since January 2024, just indicating fewer people filing for unemployment insurance. Like I said, job market isn't necessarily booming, but it also is not in a downturn. We expect these volatile numbers, when we met last time, you'd see there were large negative, large positive swings. We're going to keep expecting this volatility to continue, which is why we're going to keep our eye on the trend overall and the jobless claims, because those are a little more real-time data points. Continuing on, kind of diving into some of the labor market data, I apologize for how out of date this chart looks. Unfortunately, Bloomberg was the only place to find this data. This is something that the Conference Board collects from its consumer confidence survey. This indicator shows the difference between those that say jobs are plentiful and those that say jobs are hard to get. So kind of the positive and the negative sentiment in the job market. In July, 24.6% of surveyors said plentiful and 21.5% said hard to get, giving us the labor differential indicator, which is what you're seeing in this chart, of 3.1%. Again, a little hard to see, but this line, this 0 right here, if you look at any time this line has crossed under this 0 mark, so gone from up above it to below it, you'll see this red shading. Those, unfortunately, are recessions. So during history of results, dating back to 1967 for this indicator, anytime the reading has turned negative, the economy has gone into or is already in a recession. Again, with a lot of the stuff that happened because of COVID, the low fire environment we're in, there have been plenty of indicators over the last couple of years that have predicted every recession up until now. It would say we're currently in a recession, but obviously that's not happening. And again, this reading isn't going past 0, so it's not even flashing that we are in or going to experience a recession. But again, it's just whenever we're looking at data points, we kind of stack it in one of 3 buckets. Is it flashing red? Is it neutral? Or is it in the green? This one, I just said 3 buckets, but I'm going to make a 4th one. I would say this is in that orange category. Obviously getting dangerously close to people saying jobs are harder to get than they are plentiful. So again, just another one of many things we're going to keep our eye on in the 3rd quarter as well. And then I just want to put something together to kind of show there's been a lot of talk, and we've talked a lot about AI's implication on the job market. A lot of people said AI was going to displace workers, destroy the job market. Robots are going to take over. Not going to be enough jobs for people. A lot of things have been said. So I just want to dive into some of the actual numbers. Looking into the sector hiring, employment growth in AI exposed industries, the chart on the left. I apologize, it's a little small, but it's looking into software, which has been in the news recently, taking a nosedive because all these models are going to wipe out any need for any software companies. So that's where you see this larger dive in the beginning or end of 2025. And then if you can see it, the lines rebound. So these are marketing, consulting, graphic design, office administration. These are all kind of sectors within the software space. So you can see a reversal of that trend in that they're actually hiring more now. Revelio Labs and Ramp completed a study that found that employers that adopted AI actually hired faster than those that did not. Headcount grew by 10.2% in the 24 months after adopting AI, although there were no noticeable employment changes for those with little to no AI adoption. So something we mentioned before, studies have shown that whenever a new technology comes into place, there's displacement in the short term, while the long-term trend is growth in the sector overall and creation of new jobs that those workers are then trained up and into. So we believe that that's kind of what we're seeing with some of these sectors of the AI trade or the AI market. Moving on to the second box, wage growth. So Vanguard did some calculations in a study and actually found, so the one on the left, occupations with high AI exposure, and then the two bars on the right, all other occupations. So the light green bar is pre-COVID, 2015, 2019, and then the bluer bar is post-COVID. So you can see those with high AI exposure, the wage growth went from 0.1% to 3.8%, and then all other occupations, those that don't have high AI exposure, it only grew by 0.2%. So again, probably a very small sample size compared to the overall market and economy, but we're starting to see signs that some of this doom and gloom that's being spread about AI isn't all it was chalked up to be, which is good for growth and for the U.S. in the long term. And then 3, firm foundations, so new business applications and productivity. An extremely simple but effective bar chart. It show in June, BLS saw business applications up 15% year over year on a 3-month average, and then a 2026 small business credit survey. It's a graph you see, the bar you see here, a large portion of small businesses surveyed are seeing sizable boosts in productivity. So that's something, again, we've talked about a lot. AI, if we're not going to see a lot of job growth or labor growth, we're going to need to see a lot of productivity growth, which is unfortunately is harder to measure. But from people that are looking at it, we're starting to see some gains there, which is, it's good. But for the real change is going to come if these businesses can turn productivity from a time or operational save into a boost in revenue growth and real durable efficiency gains. So I think that's the next big step or data piece that we will look out for. And then another chart we've seen a lot, inflation breakdown. So core CPI reading for June was 3.5%, lower than the prior 2 months due to the easing tensions in the Iranian conflict. Shelter, again, remains, shelters, this blue bar remains one of the largest contributors. And then you can see the energy in the green up top. You can see, you can pretty much tell when the conflict started based on what these energy spikes happened. Again, these are really short for now. They're short-term volatility, but are often less important in the long term. Obviously, that can change the longer this conflict goes on. The longer energy prices are heightened, the higher probability that people that have to pay these elevated prices are going to pass it on somehow down the supply chain or to consumers. So having really embedding itself in the core inflation numbers, which is why we want to look at something, or, again, like that real GDP, and then the final sales to domestic producers, like trimming down the noise, the short-term volatility, and really looking at the long-term trend. So that's what we're trying to do here by looking at median or trimmed mean inflation. They remove the extreme price movements in energy and allow us to look at the trends. So the median inflation was at 2.7% for the median PCE, and the trimmed mean PCE was at 2.2%. Fed Chair Warsh has said these are measures that he favors and has discussed as tools that the Fed may start looking at more closely. Although they are lower than headline and core PCE, we still want to remember they are both still above the Fed's 2% target for inflation. Although if you look at the trends for middle to end of 2025 to now, they do seem to be moving in the right direction. I'm going to actually skip this poll question for now. Sorry about that. And we're going to go into something much more fun, federal finances. So This is something I don't think we touched on this last webinar because there's usually not really an update except it's getting worse, unfortunately, which it's not something that, it's great to talk about, but it's something that we keep saying eventually is going to be a big topic of discussion, and it's unfortunately looking like it's going to be discussed when it becomes too big of a problem to fix. So defense spending, if you look at this total spending bar, it has this orange up top. So this is the 2026 federal budget. On the left is total spending, and on the right is how we're financing that spend. So with the conflict in Iran, and even in what the materials we provide to Ukraine, or what the conflict in Gaza, defense spending has obviously gone up. Medicaid, Medicare costs, and Social Security costs will rise over the coming years as the largest generation ages into retirement. And on the bottom bar, net interest. So this big slice is just interest that we're paying on the debt that we already owe. And obviously, as our debt grows, the interest grows, and that only gets worse the higher rates are, which we'll get into in a little bit. So it's crazy. If you look at this top right chart, the U.S. government has not had a financial surplus since 2001. It's almost 25 years of being in a deficit, adding to our total deficit and adding interest expense on top of that. You can see this lined bar up here. 1/4 of our financing is the deficit. We have to finance 1/4 of our total spending through debt. And then that feeds right into this bottom right chart. So this is debt as a percentage of GDP. Currently, we're right around the 100% of GDP mark. This is projecting by 2036, so 10 years, we will be up to 120% debt as a percentage of GDP. Again, it's hard for anything to change because you really have to either tax more to get more revenue or spend less. That's really something hard for congressmen or women to pass on because usually it's pretty unpopular and you're probably not going to get a vote again the next time you run. So it's going to be difficult to change, but something that definitely will need to be addressed fairly soon. And then this chart, this just goes into kind of what I was saying. So the blue bar is baseline, how much our interest, just the interest, is going to cost. The green line, so 1.7 trillion in additional interest costs with just 45 basis points higher interest rate, which if you go back to my first slide, that happened in 1 quarter. So I'm not saying it's going to happen again, but I'm just saying how quickly it can happen and look how much it adds. This, again, is just the interest expense, net interest that we're paying on our debt. So again, the picture is not getting better by itself. Touching on the Fed and rates. So as I mentioned, the new Warsh Fed took over for Jerome Powell in May. They have not, I'll start with this, they've held their policy rate steady every meeting he's had. So there's been, especially last meeting, which we'll get into, people were, kind of expecting they might have hiked, but they've held still. He's kind of had these 4 blocks that he's focusing on. So one is 5 policy task forces, looking at communications, balance sheet, productivity and jobs, data, inflation. So a lot of the things we talk about and look at, I mentioned the inflation measure. To me, it seems like he's revamping systems. These processes have been in place for a long time. We've made a lot of policy changes that might shift how we need to look at things. So his findings will go to the members of the board first, and I think they're due by the end of this year. The second one, he's denying the 2020 framework. It was the flexible average inflation targeting. He calls it a mistake. It was basically, it allowed the Fed to aim for inflation above 2% after periods of below target growth, just kind of like allowing inflation to get a little hot so that we could catch up on, help support employment that we technically missed out on in prior years. So he called that a mistake, and so he's going to stick firm to that 2% inflation target. 3, something we've talked about, no forward guidance. So something he opposes, you don't want to signal to the market or tell them exactly what you're going to do, because then you're less likely to react to data. You're kind of entrenched because you said you were going to do this. So that's, if you veer even a little bit from that path, the market would be very upset. It could cause some pain. And 4, fewer, shorter communications. So dramatically shorter policy statement, shorter press conference, and hints of fewer of them. He's recently brought that up. He wants to do less of the conferences. And then he says balance sheet changes pre-announced well in advance. So these are just kind of some of the differences that we have seen and might see as we get further into the Warsh Fed era. And I saw this, the chief economist at Apollo made this chart. This is the 10-year yield on the day of their last meeting. So starts off low. They release a statement first, and then usually Warsh, the Fed chair gets in front of reporters, answers a few questions, and then you can see this last note. The president said Warsh would love to see lower interest rates. So only a few questions led to lots of uncertainty. You can see when it started that the yield started spiking. 2 things that have already become associated with how the new Fed operates is uncertainty and volatility. So everyone knows, we've heard the 2% inflation number over and over, but because they haven't given much guidance, the market doesn't know if that's coming from higher rates, a smaller balance sheet, or tighter financial conditions. So that answer has significant implications for the curve and the path towards 2%. So we're not saying we don't have confidence or belief that they'll get there. We just think the road there might be a little bit more bumpy because of, the cloudiness around the path. And then this is looking at the 2, 10, and 30-year Treasury rate, and then the effective federal funds rate in orange. This is over the last year. You can see that the rates have been in a steady uptrend since early March. The conflict started on February 28th and led to a hot PPI print in March that kind of kicked things off. And then right in the middle of March, probably right around here, the Fed held rates and raised their PCE forecast. So again, just another inflation forecast from 2.4% to 2.7%, which is the largest upward revision since June 2022. This pretty much led to I think around here we were at 50-50 chance of a staying steady or a rate cut, actually. And then this quickly removed, probably not 50-50, but around there. And that removed any chance of a rate cut and caused all yields to go into this uptrend that we've seen. And then this pretty simple graph, so it's just showing probabilities for what's going to happen in the September Fed meeting. So this is our current policy rate. It says right here, 350 to 375. So there's a 45% chance, the market's putting a 45% chance that they hold steady based on everything we know up to today, and a 55% chance that they actually hike based on all available information we have today. 1 week ago, the probabilities were actually at 37% and 63%. Most believe we were going to hike. So with some of the data that we've gotten in a possible end to the Iranian conflict, those odds have gotten closer to a coin flip. Speaking of that, just want to touch on geopolitics quickly. Quick timeline up top. It's a lot of back and forth. The only thing I know for certain is when the war began. Everything since then is Strait's been open, Strait's been closed, someone's been fired at, somebody violated a piece or a not a non-fire. I'm forgetting the word right now. But currently, I think yesterday they said both sides said a deal was extremely close. I think they've said that for the last 3 days, but nothing's actually, there's been no signature on the dotted line. So markets kind of went the other way today. I think oil was up because people kind of priced in the end of this conflict, but it looks like we might be back on the other side of the yo-yo. Market transmission and what matters next down here. So obviously with the Hormuz disruption, the oil supply shock, the energy, the inflation bump that we've seen, just went over what's happened with rates and the dilemma that causes with the Fed. Risk, obviously, anytime there's geopolitical problems, it's going to cause volatility in markets, especially when it's somebody who has a pretty heavy grip on a commodity like oil. And then just keeping an eye on the dollar as well, whether it's a flight to quality or what happens because of the oil shock. And then, like I said, what matters next, de-escalation and the Strait reopening is the big thing, would cause oil to fall. And again, that inflation relief that we're looking for. If there's stalled peace, like I said, if we could keep going back and forth, we could see oil rebound, the Fed remaining to hold still. And then if there's re-escalation, if the Strait closes, we'd see oil really spike, and then you run into the risk of seeing stagflation, which may be worst case for the Fed. So touching on markets, S&P has crossed above. This is a graph looking at the S&P 500 price index. The S&P has crossed above 7,700 this week for the first time ever. 10 years ago, it was 2,200, which is pretty crazy to think about. I mean, you can see since the snapback, this bottom, which is COVID, it's really just taken off. This is great growth even before then, but the exponential growth we've seen, which we've talked about ad nauseum over the last 5-6 years, has been unbelievable. We've had 25 all-time highs just this year. So still have 4 months to go. I'm sure, never know. We can never predict what's going to happen, but I would say we're probably going to have a couple more before year end. So I found this slide and I like it because it shows the S&P earnings year-to-date return, this orange line, and then it's got it broken down by earnings contribution, so the darker blue, and then PE contribution, which is the lighter blue. And, we don't need to really focus on the individual sectors. What we can look at is this top line. So the return right under 10%, earnings contribution, let's call it 32%, and then PE contribution negative 18%. So this is really a reversal of what's been propping the market up for the last, 4 or 5 years. EPS growth has been dramatic, especially this quarter. So we continue to see extremely strong earnings growth this year. As of 7/31, FactSet had these numbers after 61% of companies have reported, so almost 2/3. 47.4% blended EPS growth year over year, 14.1% revenue growth, and a 77% revenue beat rate. There's only one sector showing year-over-year decline, and that was healthcare. Headline number of 47.4%. It was great, but it was heavily influenced by two companies, Alphabet, parent company of Google, and Amazon, who benefited from investments in Anthropic and SpaceX. So if you remove these gains, they're not like ordinary daily revenue from daily operations. We saw the growth rate come back down to about 30%. This is still the strongest earnings since 2021, and at a level you usually don't see outside of recoveries, as you can see. So 2021, after the great financial crisis, again, you see that that's the only other time this bar has been that high. So it's very unique, especially when you when you see that, and we're not currently coming out of, we're not coming out of a recession. Something we want to keep an eye on, and something that might be unique and why this number is heavily inflated, is accounting conventions. So most expenses like wages get deducted from sales as a cost or expense, and profit is the number you get after. CapEx, the number that a lot of these companies are spending outrageous dollars on, is treated differently. So it's recognized as PPE, basically property or equipment, on the balance sheet, and costs are recognized on, or revenue is recognized on the income statement over time. So the people basically that are selling to hyperscalers, like chip makers, collect their money and count profits right away. So they're seeing a lot of revenue right now. Whereas these hyperscalers, the amount that they're spending on this property, they don't count it all against their revenue up front. They depreciate it over a number of years, so it gets spread out. So it's not as large of a hit right now as it might be. A lot of businesses depreciate. I'm not saying it's a malpractice, but we hear and see that all these models are advancing at such a quick pace, and these chips, there's a new chip, new version, better and better, and they're getting faster and faster at doing that, but then they're being depreciated over 8-10 years. So they're having to spend on a new chip every 2 years, but they're only recognizing the costs over 10 years. So obviously that could, if that is happening at a large scale, could be a reason behind these large EPS numbers. This was, ending on a positive note, the 7th consecutive quarter of double-digit earnings growth, which is, again, pretty unbelievable. And then the other side of the coin, valuation. So again, they've been, they've been extremely elevated from, call it, end of 2023 until, let's say beginning of this year. We had all these tech companies, all these hyperscalers trading at insane multiples, and really driving the market. Even though we've seen this number come down, you can see that it's still, the latest reading, forward PE at 20.2, is still above the 30-year average. And the Schiller PE, which, just a reminder, is if we think about inflation and bring that in the mix, it's 41.6, well above the 30-year average of 28.8. And then dividend yield, 1.3 versus 2%. So these companies aren't paying you cash. It's not necessarily, again, a bad thing, but then we look at earnings yield minus the yield on a bond. So the latest is negative 0.6%, 30-year average 7%. And again, that's just saying that you're not getting paid basically for the risk you're taking, or you can get a higher yield while being parked in bonds and not taking on the risk of being exposed to some of these equities. And then just something I wanted to kind of round off this section with. So as I said, a lot of spending going on with AI build out with data centers. It's increasing earnings of industrial companies in addition to chip makers. So we have Sherwin-Williams. I'm just going to focus on the first one. Sherwin-Williams, a paint maker, smashed earnings and saw its stock go up over 8% after hours. Usually this company, you only see this big of a beat if there was a boom in, commercial or residential construction. They're actually selling protective coating products to those building data centers. So we're really seeing the AI story spread to all parts of the economy. And again, right now it's great, right? They're bringing in more revenue, generating more sales, but all of that, it's just becoming more concentrated. So on the way up, it's great, but if it ever turned the other way and started to go down, we could see it drop pretty dramatically for a wide range of these companies. Speaking of AI build out and AI CapEx spending, so they're very large numbers. It's just a graph of spending year to date on CapEx for Amazon, Alphabet, Microsoft, and Meta, formerly Facebook. 2026 estimated CapEx for these 5 companies is 700 to 720 billion, which is a 5-time increase since 2023. Obviously, these are staggering numbers, but just to play devil's advocate to the other side of the coin, just a few years ago, there were a lot who were criticizing a lot of these companies for how much cash they were kind of hoarding on the sidelines and that they weren't reinvesting into the business. Now these companies have spent pretty much all of their cash flow, and the biggest critique is that they spend too much. So that's kind of the battle that we're going to see play out over the coming years, is not necessarily who is right, but if all this spending is going to turn into and generate the appropriate amount of revenue. And then speaking of that, justifying the spend. So the dark blue is Microsoft's return, and then from the beginning of July until they posted earnings, and Meta did this on the same day. They're the light blue line. So Meta's AI capex was up 81% to 31.1 billion. Again, absorbing almost all of its free cash flow, while Microsoft left its capex plans unchanged. So there's an increase there for Meta, and Microsoft said, okay, we're good on spending right now. Both showed AI revenue. So Meta's ad revenue was up 27%. Azure passed 100 billion in full year 2026 revenue and was up 41%. However, as you can see, it rebounded a little, but after hours, Meta fell 10%, and Microsoft was only up 9% after hours, but obviously kept going. The reason being Microsoft converted spend into reoccurring cloud revenue line. The market's now pricing AI capital efficiency, not just AI ambition. So it's kind of, we know everyone's spending money, but now we want to see the dollars start coming in. So this is honestly good for the overall market. We don't want everyone to just go up like they were last year, because they're spending all these numbers, right? That's when you start getting the bubble fears, the bubble talk. We can still see some of these kind of unbelievable eye-popping revenue numbers, as long as those that aren't performing are, not being punished necessarily, but are being valued accordingly. And then kind of touching on the last piece on the risk of some of these hyperscalers. So this is Oracle, Google, Microsoft, Amazon, Meta, SpaceX, a lot of these big tech companies. And so the bigger ones, the Googles, the Microsoft, the Amazons, the Metas, they're down here. You've seen their spreads. So CDSs are derivative swap agreements. So they're insurance for bondholders. So the cost, if you see this line go up, it basically means that these companies are getting more risky. The cost to contain this risk has risen almost 50%. The odds of default on any of these 5 names over the next 5 years has risen from 8.6% to almost 12%. You can see, obviously, Oracle is responsible for a large slice of that pie. But the bond market is asking, can these commitments be repaid? So Oracle spread widened, not because it turned into a bad company overnight, but because of a large share of its free cash flow. It's dependent on OpenAI's profitability, which has come under question recently. And with some of the circular financing deals that we've seen, I think we showed that graphic a couple webinars ago of, Meta invests in OpenAI, OpenAI invests in Anthropic, Anthropic invests in Meta. It's just one big circle, right? So there's no real winners and losers. It's just everyone's kind of going in a circle. The market is it's obviously noticed that, but it's starting to price that in to how much these hyperscalers are going to have to pay to finance some of this spending. And then Pacing the Frontier. So this was last month, a petition named Pacing the Frontier was signed by more than 1,200 employees at leading AI companies, basically just telling Washington, like, this stuff is moving quickly and we need to agree on something at an international level to make sure we can hit the brakes if things go too fast. It used to be an idea held by people who opposed AI, but now it's even co-founders and leaders of the largest AI companies in the world. The problem is AI may be safer if everyone slows down at the same time, but any company or country that slows down by itself risks falling behind and out of the AI arms race. So U.S. policymakers are pretty fearful to make an agreement because the slowdown would quickly erase any lead that the U.S. has on China in regards to AI. So those are, again, the two forces battling each other there, but it's pretty interesting to see that even the people who are dealing with this stuff day to day are saying, we might need to slow down here. Finally, financial systems. So we saw a record amount of sports gambling in 2025. $166 billion was bet on sporting events in the U.S. That's more than double the amount that was spent on movies, recorded music, live music, books, and museums. Nothing wrong with not calling out anyone who's sports gambling. I just want to, people are taking risk. This might not be in the stock market, but we've definitely seen that risk-taking behavior bleed over a little bit. So this is June FINRA data. Customer margin reached $1.5 trillion, up 49% year over year, with $494 billion added just over the last 12 months. There have only been 3 periods since 1997 with sustained year-over-year growth over 40%. I should have made this a poll question, but you can probably guess what 3 periods I'm about to say. Late 1999 and 2000, mid-2007, and 2021. So each followed by a margin debt drawdown of at least 35% and an equity market correction. In March, the ratio of margin debt to M2, so money supply, basically the money moving throughout our financial system, reached levels comparable to 2008 and approaching the dot-com peak. And actually, since March, that level has now been surpassed. This also doesn't include almost $200 billion in leveraged ETFs. There are almost 900 leveraged products now trading in the U.S., and more than 400 of those are on a single name stock. That was via Morningstar. So this is kind of a case study of something that just recently happened involving this leverage. So Korea, shows what can happen when a market becomes propped up on leverage. Also doesn't help that at its peak, more than 50% of the index was concentrated in 2 AI names, Samsung and SK Hynix. Circuit breakers are shutting off temporarily the stock market has occurred in Korea 5 times in 2026 alone, signaling extreme market volatility. While this isn't foreshadowing what's going to happen in the U.S., because Korea is more of an emerging market name, U.S. is obviously well developed. They recently made short selling legal in March, but are exploring a temporary ban. They just approved single stock levered ETFs because they wanted to keep money from going into other markets, like coming over here to the U.S., so they wanted to keep their domestic money there. So they're trying to come up with ways to do that. But unfortunately, they're moving a little too fast, and they paid for it. You can see this chart was from June 1st to June 5th. So 4 days, this is an ETF that tracks their market. So let's think of SPY for the United States, for S&P 500. It was down 20% in 4 days. It's a lesson on concentration. It's a lesson on taking too much risk. It's a lesson on being greedy. A lesson we need to keep in mind, back of our heads, but not something. I'm not saying this is going to happen anytime soon in the U.S., but just something we need to remember with our own markets and when we're investing in some of these developed markets that are moving a little bit too fast. And situational awareness, LP. So I'm not sure if some of you saw the story. Like I said, the risk taking isn't as extreme in the U.S., but some bad actors are being punished. This man, Leopold, I'm not going to attempt his last name, was an OpenAI researcher who left the company and started his own hedge fund in 2024. He wrote a 165-page essay named Situational Awareness, basically the future of AI, how it's going to change the world, all of that. So the fund he started at one point had since inception returns, remember it started in 2024, of over 1,000%. Peaked at 45 billion in assets in the beginning of July. However, it was driven by reported leverage of up to 400%. And one of his largest holdings, which I just mentioned, was SK Hynix. So when that stock took a tumble, the value of his fund dropped, and he began receiving margin calls from the banks he had taken loans at, whether it was J.P. Morgan, I think Bank of America, and was forced to eventually sell his fund at a discount to a larger firm, Citadel, who's run by Ken Griffin. So this shows that even if his views on AI are correct in the long term, kind of thinking about even if all this money that we're spending, it's for the right reasons, AI is going to change mankind, that doesn't guarantee a smooth ride along the way and unlimited profits on the way there. There are going to be people who unfortunately lose out. Not all these companies can win at the end of the day, whether it be they take the wrong risk or there's competition. Things can't just keep going up. So we're starting to see, like I mentioned, some of the shakeout, which in the end is healthy. It's good for markets. So we'll just want to keep an eye on the risk taking moving forward and into Q3. With that, Sean, I will pass it to you.
All right. Thanks, Rex. Now that Rex has given us the macro backdrop, the market backdrop, some AI stuff, let's try and translate this into what it actually means for the way we think about portfolios. So this first chart here is showing us the equity risk premium in several different developed areas. And you can see the equity risk premium is the forward earnings yield, which is just the inverse of the valuation. So you just, valuation is price over earnings. So you look at a stock as earnings over price. So you look at it more like a bond. And what's the yield? And they call that the earnings yield. What's the earnings yield of a stock market? And then we subtract the 10-year real yield. So literally, how much extra were we paid, or do we think we're going to be paid for owning stocks over owning a safe inflation protected bond? So that is what makes up this equity risk premium. All else being equal, you want a higher equity risk premium. You're getting paid more for the same amount of risk. The U.S. sits at the bottom here and is of all these major developed markets at 2.7%. It doesn't mean that we need to abandon U.S. equities. It's just telling us we have a valuation signal. We have a lower cushion over bonds, so that if some of these things that Rex was talking about, 17% profit margins, if that reverts back to the mean, because hey, when if we're capitalists and we see somebody making 17% profit margin, there's usually competition that comes in and brings that profit margin down, and maybe earnings disappoint going forward. If they disappoint just a tiny bit, we don't have a lot of cushion here with our equity risk premium. Where else this plays out is when we look at valuations globally. There's two charts here. The one on the left is looking at developed markets from a PE standpoint versus the S&P 500. The chart on the right is the same exact chart, but it's emerging markets versus the S&P 500. Despite significant improvement relative to the S&P 500 over the last 18 months, the developed international markets on the left here, you've got a big V here, but despite outperforming the developed international markets outperformed domestic markets by 15% from January 1st, 2025 through the middle of 2026. And despite a 15% outperformance, we're still discounted in developed international versus the S&P. Emerging markets is even worse. We've got a 0.52 times relative PE versus the S&P 500, basically at the bottom of this 15-year period of time. So international just isn't offering a better risk premium, previous slide. It's doing so statistically with cheap valuations relative to the S&P 500. So this just tells us that international is probably an area that we need to make sure that we have a good proportion of our portfolio, because on a relative basis, it looks a little bit more attractive, has a little bit more cushion in case things don't go exactly how we anticipate. Which brings us, let's take a look more at domestic valuations. And I know Rex and I have added this slide into almost every single one of our market insights presentations, and there's a reason for that. The chart on the left shows valuations and subsequent one-year returns. There's really no correlation whatsoever. You can see those dots are all over the place around that orange line on the left. However, on the right side, we have a much more correlated data set, and the basic data is the higher the starting PE multiple, the lower the forward 5-year annualized returns. And it's not perfect. To be clear, it's a probabilistic relationship, not a forecast. There's real dispersion around that orange line, but starting valuation has historically been a meaningful drag on forward large cap returns from levels like we see now, around 20. This is the valuation argument, not concentrating too much of your portfolio in U.S. large caps, in U.S. large caps alone. If you've been lucky enough to have a big chunk of your portfolio in the S&P 500 to this point, wonderful. You've done absolutely fantastic the last 10, 15 years. It might be a good time to really evaluate how much exposure you want to keep here and possibly diversify to other areas. Now, let's flip to fixed income. This chart plots starting yield to worst against 5-year annualized returns from the Bloomberg Aggregate Index, going back all the way to the 1970s. The relationship is remarkably tight with an R squared of 89%. So this tells us the correlation between starting yield and future returns is very, very high. As of August 4th, the current yield of 4.89% implies a 5-year forward annualized return of roughly 4.96%. In other words, today's starting yield is a very good predictor of what bonds are likely to deliver going forward. Unlike equities, where valuations give you a loose probabilistic signal, bond yields have been a much stronger predictor of future returns. Yield today is close to return to tomorrow. That's the core argument for fixed income right now. Starting point itself is very attractive, especially given some of our expected returns from some of our more aggressive equities over the next 10 years. And then if we pair that with the fact that bonds have much less volatility versus equities, you get even more attractive risk-adjusted return outlook for bonds versus some domestic equities. So that's the starting case for bonds. And if we dive into bonds a little bit further, we can parse it out into two kind of segments. there's this dotted line right here in the middle. The chart here shows yield to worst across the whole entire fixed income spectrum. Core sectors like treasuries, munis, investment grade corporates, mortgage-backed securities are on the left. And you can see that today their yields are at the high levels of this 15-year range, versus if we look at credit type fixed income like high yield, emerging market debt, and leveraged loans, we're not at the high level of the 15-year range. We're more in the median of the 15-year range. Now, headline yields across the board compared to the last 10 or 15 years, they look attractive. We haven't seen yields like this for a very long time. However, credit spreads, the spread over an equivalent treasury in some of these higher yielding or credit exposed fixed income instruments, the spreads are very tight. We're not getting paid to take incremental risk in some of these higher risk type bonds. They look, some of them look pretty good. I mean, leveraged loans, you're at 8.7% yield. You just have to understand that you're taking a lot more risk to get that 8.7% yield than, let's say, a treasury, a 10-year treasury that's yielding, as of today, call it 4.65%. So the message is nuanced. Attractive all-in yields, but we need to be selective here. This favors quality and duration over reaching for yield where there's very tight credit spreads. Which brings me to my last couple slides here, and these ones we always go over as well. This chart shows the range of outcomes for stocks, bonds, and a 60-40 blend across rolling 1 year, 5 year, 10 year, and 20 year periods going back to 1950. At a 1 year time horizon, stocks have ranged from 52% positive to minus 37%, a giant spread. That range compresses dramatically as the holding period lengthens. By 20-year rolling periods, stocks have never had a negative 20-year period, ranging from 6% annualized return over the 20-year period, all the way up to 15%, or no, 18% annualized. The table tells the same story if we look at dollars. $100,000 invested in stocks grew to roughly $908,000 over 20 years versus about $278,000 in bonds, and then $607,000 in the 60-40 blend. The takeaway here is we need to match our risk and our time horizon. If you need money soon, a wide range of possible outcomes could be disastrous if you need the money in a short period of time. You may not have time to recover from a 37% drawdown if we were looking at stocks. If your horizon is long, that same volatility has historically been the source of the outperformance, not a threat to it. So the law, if we know we have 20 years, then it's a lot easier for us to not look at what's currently happening, because we don't need this money for 20 years, and we're going to be rewarded by time in the market versus timing the market. And then just another way to look at this, we get paid for the risk that we take. This chart shows the growth of $10,000 adjusted for inflation from 96 to 2025 across large cap, small cap, corporate bonds, and cash. Large cap stocks, that $10,000 grew to almost $91,000 in real terms, so that's after inflation. Small caps 55,000 and some change. Corporate bonds, just over 24,000. And if we held cash the entire time, we didn't even keep up with inflation. Our $10,000 is worth less inflation adjusted. That means that inflation had a better return than cash over this time frame. Along the way, there's been real turbulence. You can see some of the market drops here in 2000 to 2002, 2008, 2009, 2020, 2022. But the long run trend for risk assets is undeniably up and to the right. Time in the market, not time in the market. So with that, I'm going to throw it to Remy, and he's going to walk us through a Q&A.
Scene Rex, thank you for those valuable insights. I think that there's a lot of noise out there, and I think it's important to really drill down on what is most important to focus on. So we appreciate you both kind of honing in on that for us. So Rex, just a few questions coming from our participants. First one we have, what businesses and or companies do you feel will benefit the most from AI, in the long term?
Yeah, so I kind of touched on this a little bit, that we've started to see some, bleeding through from these. It was for the last couple of years, NVIDIA, the big hyperscalers, these big tech companies were raking in a lot of the cash. Then we kind of saw it move in the memory sector away from hardware. I mentioned it's moving into more of the industrials. So it seems like it's gonna be pretty broad based across the economy. I mean, and that's part of the hard part with trying to be so diversified right now, is that it's really everywhere. If usually if you want to be diversified against equities or bonds, you want to be in real estate. But now a lot of these real estate funds are heavily invested in some part of the AI build out, usually with data centers. So like I mentioned, it's a good thing, right? Because this money is being spread around, it's being spent, companies are growing, they're hiring. So it's all good right now, and I don't know what sector is going to be next. I don't think anybody really knows. If you do, please send me an email. But if something turns, if these doom and gloom people are right at some point, if we just spend too much, even the AI could be the greatest thing ever made. But if we get out over our skis, like we saw with Korea, things can come down just as quick as or quicker than they went up.
That makes sense. The second question we have is, what effect does the tariff back and forth have on us?
Yeah, so I didn't. I took it. I had it in the main deck. I pushed it. It was right there. I pushed it to the back here. Again, it's been the kind of calling card of this administration. It was called the taco trade at one point. Tariffs, as you can see, when we first had the tariff tantrum in, it's crazy, it's been that long, April 2025, the effective tariff rate or average tariff rate was 30%. Obviously, we remember how much chaos and volatility and drop in markets that caused. It's come down dramatically, especially with the last occurrence, the federal court striking down and saying that Trump couldn't enact most of these tariffs, and the refunds that are happening. Obviously, it's in the news right now that Trump's trying to circumvent this and force tariffs a different way. So, and I hate continue to give this answer, but it's going to be tough to tell exactly what can happen. If you remember what happened initially, I don't think that's going to happen again, because that level's at 3 times what we're at now, and that was more of a posturing move or a tactic for negotiations more than anything. We're obviously at 10% still higher than we've been in a long time. But like I said, with a lot of refunds happening and a lot of more court cases popping up, I think this is going to be kind of drawn out as well. So I'd expect the effects in either way, whether it helps us bring in more revenue to work against that deficit, or if it raises inflation because prices start being passed on the consumer. Either way it goes, I think it probably gets drawn out over time, and we're not feeling as large of an impact in either direction.
That makes sense. Thank you for that. There's certainly a lot of ambiguity that leads us into the second half of the year. We wanted to thank everyone for joining today's webinar. We wanted to before we finish up, we wanted to ask if there's any final questions anyone may have. If so, please feel free to write them in the question box. I think we are wrapping up and all set here. Again, we appreciate everyone joining the webinar, and we really look forward to the next one. Thank you.
Thank you.
Thanks, everyone.